So, Chris, welcome. Um, so, it's a pleasure to have Chris Knittel, who's the George P. Schultz Professor of Applied Economics at the Sloan School of Management, to talk about his view on decarbonization in a post-coronavirus world. Chris, let me just give it to you now so you have all the
Great.
time you can.
Thanks, Bob. Thank you very much for having me. I appreciate being on here, and I certainly welcome the conversation. So, as Bob mentioned, I'm an economist in the Sloan School, also the director of the Center for Energy and Environmental Policy Research, and the co-director of the Electric Power System Low Carbon Energy Center, which sits under the MITei Energy Initiative. So, I give a lot of thought on how different policies impact behavior and emissions and health outcomes. And given this crisis, a group of us have been also giving thoughts, or at least thinking hard about how this crisis is going to impact behavior, emissions, etc. So what I wanted to talk a little bit about today is some recent work. Actually, we just submitted it yesterday. So it's very recent work where we look at the short run effects and postulate on the long run effects of the crisis on carbon emissions and decarbonization. And that's going to encompass changes in consumer behavior, but also policy behavior and firm behavior. Certainly, as you'll see, the short run is much easier to talk about and measure. The long run will have large standard error bands or confidence intervals around it, but it's at least our first attempt to try to understand how this crisis might impact long-run emissions within the U.S. And there's a few very large unknowns that I'm going to discuss. And Bob mentioned one, which is that the crisis might actually move our society or our country into more science-backed and evidence-based policies. And that's a reason to be optimistic about how the crisis might impact climate change policy and so on. But Bob's an electrical engineer. They tend to be optimistic. I'm an economist. We tend to be pessimistic. So I'm going to talk about some other effects that actually might delay the decarbonization of both the electricity sector and the transportation sector. First, a shout out to my co-authors on this, Ken Gillingham at Yale, my colleague at Sloan, Jing Li, Martin Overe at Yale, and Mara Regwent at Northwestern. So as I mentioned, I'm going to start by just showing some graphs on what has happened to short-run emissions, not just carbon emissions, but I'll also talk about criteria pollutant emissions. And in the project, we're also measuring the health impacts of that, but I'm not going to focus on those too much, but just show you the stark changes in behavior since the crisis. And I know you're all sitting at home right now, so we all understand where that behavior or how that behavior has changed, but what we're trying to do, at least in the short run analysis, is put numbers to it and trying to understand the impact of that on emissions. When I get to the long run, it's certainly much more complex, and here are the issues at play here. And this is just the beginning of this project, and we want to do some more sophisticated modeling around this. As of yet, we're doing more back-of-the-envelope calculations on just what might happen to carbon emissions in the long run from the crisis. And setting aside Bob's optimistic point, which I agree with, that hopefully this will move the conversation to be more science-based. There are a couple other impacts that are likely to delay decarbonization and increase carbon emissions. The first is that states have much smaller budgets now, so they may not have the appetite to push hard on subsidies or policies that are going to tend to promote low carbon technologies. Most of the action over the last decade in the electric power system in terms of carbon policy has been at the states. So that operates through renewable portfolio standards, explicit subsidies for solar and wind. But one big question is whether or not states will continue to be able to do that over the next few years. And any short-run delay of policies like that can have long-term consequences. Even if it's only over 1 or 2 years, it can have long-term consequences, because we know in the renewable space and in many other industries, there's significant learning by doing effects and research and development effects. So if you're promoting renewables less today, that puts you on a higher cost path of renewables in the future. And those impacts can augment from there. The second one is, and you probably, I study oil markets and transportation markets quite a bit. You might have heard about negative oil prices. That's partly due to the crisis, also partly due to a price war between Saudi Arabia and Russia, and a breakdown of OPEC more generally. But that will also slow the transition to a low carbon transportation sector. And then finally, what we're seeing, at least in countries that are starting to open up, is that we're seeing more permanent effects on mode choice in commute patterns, that people may be a little gun shy to take public transportation. And that too will change behavior in a way that is likely to increase emissions. Of course, the flip side of that is firms in the medium and longer term may be doing more to promote telecommuting, which would tend to counterbalance those change in commute patterns. So let me talk a little bit about the short run first, because like I said, it is much easier to measure. So we in this project looked at the reduction in both use and then follow-on emissions from petroleum, other petroleum liquids, natural gas, electricity demand, and electricity generation. And the reason why I split, obviously demand equals generation, but we're going to also look at the relative impact on natural gas generation and coal generation of the recent crisis. And I should mention, just another shout out to the MIT Energy Initiative, that MITei and SEPA are working on an interface so that these data will be available to people, and some analysis easily available on a website. And we hope to have that done shortly. So what we do is we take the previous year of data and forecast forward, stopping the forecasting model in April, and then looking at the predictions that would happen or stopping the forecasting model in February, looking at the predictions of March and April relative to actual consumption. So the forecasting models vary in terms of depending on what the fuel is, but the basic structure doesn't change. So here's probably the most stark effect is on gasoline consumption. So you can see the gray line is the confidence interval of the forecasting model. And you can see almost a cut of almost 50% in gasoline consumption. Electricity consumption has fallen much smaller, probably not as surprising since we're still working just from home. So certainly many industries have shut down, and that has reduced electricity consumption. But the net effect of that is much smaller than what we see in gasoline consumption. Natural gas consumption, this is natural gas generation. So this is actually what you're going to see in a second is the impact on natural gas generation has been larger than on coal generation. In many markets, natural gas is still the marginal fuel in electricity markets. So as demand shrinks, the marginal fuel goes away much quicker than baseload generation. So there's the impact on coal generation, and one could argue that, well, certainly by the end, it's actually within the confidence interval of the forecast. We look at natural gas consumption now. This is aggregating residential and commercial. You do see some of an effect, but again, because people are at home, you're seeing negative effects on commercial natural gas consumption, but actually positive effects on residential consumption. Industrial shows a much larger reduction in impact of the crisis on short-run industrial natural gas consumption. Again, not surprising given the shutdown of many industries. Just another plot that we did, that we looked at accidents. We can get weekly accidents, vehicle accidents across 5 different states. And so the next time you get, or your insurance company tells you that they're reducing your rates, this is why. The insurance outlays are much smaller during the crisis, as people obviously aren't driving given the reduction in gasoline consumption. So we've seen a large impact on accidents and fatalities in accidents as well. So just to summarize the short run impacts, we also looked at jet fuel, that you see large impacts in the largest in gasoline and jet fuel, upwards of 40 to 50% reductions, and then 10% reductions thereabouts in electricity consumption, and natural gas consumption is between 10 and 20%. The carbon emissions from that, that's the right side of this panel. So those are taking those drops in consumption and measuring the carbon emissions. All told, that's about a 22% reduction in US CO2 emissions over March, the later part of March and April. So from a short-term effect on emissions, the crisis has led to fewer emissions. The long-run impacts, though, we look to do some, like I said, back-of-the-envelope calculations to measure what the potential is for long-run effects. And although in the future, or what would be nice is a large-scale use of an integrated assessment model, like Bob mentioned, that the joint program uses. As of yet, we haven't been able to bring in the economic concepts that would be at play here. And that is changes in learning by doing, changes in research and development that would lead to reductions in costs of renewables and electric vehicles. So we're going to leverage the DOE's annual energy outlook to look at what the impact is on the long run emissions from either delays in adoption of renewables and delays in increases in fuel economy, or what this crisis might also do is move us from a lower cost pathway of these renewables to a higher cost pathway. And the annual energy outlook actually has modeling of 2 different pathways in terms of costs. So I'm not going to show you those results now, but one could imagine what the impacts on CO2 emissions would be of moving us to that higher cost pathway because of less R&D, less learning by doing, and lower investments more generally. And then we also model the recession using the recession in 2008 to project forward what might happen to just general macroeconomic activity over the near term. So here are, the gray line here is the reference case for the annual energy outlook. And what the gray dotted line is what happens if you get moved onto that higher cost pathway. And so you could see that just doing that, the impacts can be stark. And then what the yellow lines are doing are delaying investment. And in the paper or in the project, we're looking at different lengths of delays. That's a 5-year delay there. I'm going to just show you those results again as just a benchmark or to place a bound on the potential long run impacts of the crisis. And on fuel economy, what we expect to happen is also delays in the adoption of fuel economy, both operating through less investment in electric vehicles, but coming either because of the crisis or because of the very, very low oil prices. So here are emissions. The gray line is the reference case, and the dotted lines are different models, and those are showing 2 different impacts of the potential recession that follows on here. And you can see that that emissions are about, in aggregate, about 5 to 10% higher than they would have been under a business as usual case. So you could see that there are actually real effects here at play. And this is by no means our most pessimistic model. This is just delaying the adoption of renewables and not moving us onto a higher cost pathway. That was electricity and transportation. You see these large near-term reductions coming from the reduced travel, but then the delay in fuel economy adoption also leads to about a 5% increase in emissions over the next 15 years, I should have said. So that's the net effect of including the reductions in emissions in the near term. We also look at the impacts on other pollutants and then the health impacts operating through mortality of those as well. But the bottom line here is that it's very easy to imagine a world where the crisis operating through lower state budgets, lower appetites for federal policies, federal subsidies, could move us to a pathway that leads to significantly more emissions. What is the response to that? I think the response to that is going back to Bob's optimistic view, that my hope at least is the pandemic is going to lead us to a more honest conversation about where science and how science plays a role in federal policy. And from that, policy can obviously overcome these modeling impacts, but without such a federal policy, my sense is that the states aren't going to be able to handle as much as they have, pick up the ball as much as they have over the past few years going forward. So with that, I'll stop and field questions if we have any time.
Thank you very much, Chris. So I'm going to have an immediate question, which is, what opportunity do you see here for federal price on carbon or federal investment, maybe not a price on carbon, but through the stimulus packages that we're putting together for investment in infrastructure, say, that could play towards a low carbon future? I mean, one of my favorites is transmission, because we're doing a lot of electrification now, but hydrogen infrastructure, there's an interesting opportunity in multiple regions of the country to start putting the beginnings of a hydrogen infrastructure in place. What are your thoughts on that?
Yeah, I think in some ways we might find ourselves back in 2008, where whichever administration comes in the fall, or even the current administration, is going to be looking for shovel-ready projects that kill two birds with one stone, provide macroeconomic stimulus, as well as future benefits. I do wonder whether or not the focus of that will be on healthcare, potential healthcare investments that pay off in the future. But insofar as climate change is in that conversation, I agree with you that transmission is a key shovel-ready, in many cases, opportunity. I think another opportunity with respect to transmission is just getting this right away and citing legal structure that would allow us to build transmission lines where the wind is to where the people are. That's
or from where hydro is to where
exactly.
people are, right?
Yeah, which we can't even do in the Northeast. Right?
Yeah, exactly. A couple of people ask a question, various themes on or variations on the theme of how U.S. specific are your comments. Would this look different in Europe, for example, or Scandinavia, or?
Yeah, certainly we didn't model those countries, but I think the general economic forces or political forces are at play there as well, that budgets are going to take a long time to recover from this. And that may reduce the appetite for investment in renewables. In Europe, the other thing at play is Europe operates under a European cap and trade market, and the near term reductions in emissions are going to, and they've already put downward pressure on permit prices and will continue to put downward pressure on permit prices. So that's an actual explicit mechanism that will reduce the payoffs to low carbon investment because those payoffs are not having to buy permits.
So here's a question about, given the drop in gasoline prices, oil prices generally, do you think this is an opportunity to increase the gas tax
Yeah.
to sort of keep the price level? And a second piece of that is that even remotely feasible in the U.S.?
Yeah, I can spend an hour talking about oil markets and gasoline markets. We are in quite unusual times when the President of the United States is attempting to raise oil prices. I never thought I would live the day where that's the case.
Yeah.
And if I was advising the president and I wanted to raise oil prices, the actual most effective way of doing that, and just to back up a little, the bad part of approaching OPEC and Saudi Arabia and Russia in particular to try to raise oil prices is that although that would benefit U.S. oil producers, a lot of that money is going to leave and go to the Middle East in terms, because we still do import oil. So the most effective way to raise oil prices and in turn gasoline prices is either through a gasoline tax, in which case the U.S. would collect all of the tax and be able to use that tax to either offset the higher costs to low-income households or for other projects. Or if they wanted this to be OPEC specific, we could put a tariff on imported OPEC oil, which would also raise the domestic oil price and would allow us to keep the revenues from that tariff. So those are the best ways. If we really want to safeguard the oil industry, the tariff on imported oil would raise oil prices to domestic producers and allow us to keep the money for ourselves.
Yeah. So one last question. So this one asks about the pandemic and its impacts, but asks specifically about whether you think this would be contribute to driving millennials to move away from cities, urban areas, into suburbs, say, in order to be in a less population dense area to where maybe risks of spread of coronavirus would be less. Do you see that as a factor that might play here?
I don't know. So I've done some work on how millennials drive and whether or not they're actually driving less or owning fewer cars. And the short answer to that is they're not that much different from past generations. Right. So I think just the general aging of the millennials will move them to the suburbs. But we could talk about the next generation as to whether or not that would reduce the demand for urban living more generally. And I can't see how it's not at least the pressure in that direction. That, it's a pretty high, New York's catastrophic and very sad dealing with this pandemic is such a high profile event that it seems, and this is just speculation without any data, that I would not be surprised if this reduced the demand for urban living.
It's going to be an interesting research problem going forward. Yeah. Thank you very much, Chris. As always, lots of great insights into this. And hopefully we'll get back to some more discussion at the end of the webinar.